Hi, everyone, and Happy New Year. Welcome to the first Supervest webinar of 2023. We're very excited to have you all here. And today, joining us for this webinar is our very own John Donahue, CIO, Chief Investment Officer of Supervest. Welcome, JD.
Hey, Jen. Hi, everybody. Good to be here.
All right. So, for everyone here joining the call, and for those of you that are just hopping on here, today's discussion and flow will be very conversational. We're looking to basically discuss with you all where we've been, where we plan to go in the new year. The first 20 minutes will be us just going through some of the major highlights we want to share with you all. And then at the end, the last final 10 minutes, we'll open it up to a Q&A. Everyone should have a Q&A box, so just enter your questions there. We may get to some of them during the conversation, but most will reserve to the end. So don't be shy, ask away. And anything that we don't get to on the call here today, we'll make sure to get to afterwards too. So don't be dismayed if we don't answer everyone. But let's get started. Let's jump right into it. JD, are you ready?
I'm ready, I think.
All right. So JD, can you just go over with us what were the most significant investing / marketing events of 2022 that impacted Supervest and the alternative investment community overall?
Well, I think the biggest thing, Jen, probably is looking back at 2022, really the entire investment landscape. I think everybody on the call today, parts of my own portfolio, there was really nowhere to run, nowhere to hide. Particularly if you were in traditional kind of a 60-40 portfolio that many investors on this call and like myself are invested in. Equity markets were down big, bond markets were down big, and there's been a big push into the alternative asset classes, hoping that those were not correlated to those public markets. But I think many investors found out this year there was correlation in those asset classes, particularly crypto, where we thought, I think many investors thought they could hide. That didn't turn out so well. So I think the big lesson, looking back on 2022, strictly from an investment perspective, is you've got to be aware of correlations in alternative assets relative to traditional markets, traditional 60-40 portfolios, and truly be aware that when you're looking at alternative investments, look for investments that are low in correlation. Things will always at times be correlated, but you really need to source, investments that have truly low correlation at times of market distress.
That's excellent. And to your point, GD, it seems that now during this period, a lot of investors are turning to alternative investments to sort of move away from some of those aforementioned asset classes. How do you think that this has affected the alternative investments industry?
Yeah, I think it's, I think this past year in particular, if that's the question, Jen, it's helped it, the alternative investment industry, but it's hurt it at the same time, right? Back to my point, I think some investors thought, certain quote unquote alternative investments would be a buffer or a ballast to their portfolio in times of distress in traditional public markets that we saw in the equity and bond markets. Again, mentioning crypto. I noticed, in the papers recently or in the fall, even real estate plays like, I think, not to name names, but one of the largest real estate funds out there gated investors because of questionable mark-to-market issues they may have in their portfolios. So I think to a certain degree, it aroused investors' skepticism in terms of what alternative investors could truly do for their portfolio because of those correlation issues. But at the same time, there are certain alternative investments, particularly private credit, kind of that's where the MCA industry does fall kind of on the lower end and smaller value chain in the private credit area. But those certain alternative investments benefited through 2022 because they did show their ability to show low correlation and still gain returns during a market cycle where almost everything else didn't work. So I think it's there were pluses, there were minuses, and I think it just made investors become that much more attuned, that much more aware of really what they're investing in when they get into all the alternative space. They really got to keep an eye on that correlation. They got to keep an eye on their due diligence when they're investing in these alternative markets or in the particular asset classes or the platforms or the firms that they're making those investments through.
Excellent, excellent. And speaking of due diligence and correlations, specifically with the merchant cash advance industry, we know a lot of our investors want to know. They've been curious about what are the trends that we're seeing in MCA. From Supervest's perspective, what are some of the correlations we're seeing in the merchant cash advance industry now, some of the highlights that we're seeing that we maybe want to point out to our investor base as to what we're seeing overall in the MCA space and industry?
Yeah, I'll give you kind of, if we look back at 2022, we kind of roll the movie back then. I think, in the first 2 quarters, we actually had 2 negative prints in GDP. So I think most investors were starting to think that we were in a recession, we were moving towards recession, or we're going to be in a recession, in 2023 at some point. We began to see kind of economic conditions for our merchants begin to soften a bit. Where we saw those softenings was really in kind of the lower FICO bands of the merchants, smaller kind of monthly receivables from those merchants. We also began to see kind of a softness in specific industries, I would say, and I think we telegraphed this to a lot of our investors through kind of individual calls and some of the print we put out there, but we began to see some softness in the trucking industry specifically. And when I say trucking, I really am talking about the smaller operators. And I think that was probably a function of, well, we saw, 1, the economic conditions, but 2, you kind of had the end of the pandemic and the last mile to the home kind of transportation, where everyone was ordering from their couches and their sofas from Amazon and Walmart.com and Target, et cetera. So the trucking industry really hit a boom during that period. But as things normalized and we all came out of our houses over the last year or so, the last mile to the trucking began to slow down, and we began to see that kind of in the remittance flow and the receivables from in the performance of the underlying trucking industry. So, one of the things we when we speak to people and have some calls with folks was really we tried to steer them potentially away from that trucking industry. And then also kind of move them up the quality bracket, moving away from the kind of lower FICOs, lower size merchants, the smaller merchants of the world, move them kind of up the credit quality. That's kind of what we saw kind of as a history going back, looking at 2022.
Fantastic. Now, given the economic climate that we're in, JD, we're heading into a recessionary period. A lot of our investors are also wondering, what do we think about the state of MCA given the times that we're in? What will small businesses encounter? How will that affect MCA rates, returns, etc.?
Yeah, it's a good question. I mean, I think, again, the question is, and I don't have a crystal ball. I don't know if anybody does, but we're either, in a recession probably, or we're heading towards one. I think that's what most pundits claim. I think there's certainly softness. We've got a Fed tightening right now. There's certainly a credit contraction going on out there, and it's beginning to be felt certainly in industries that are rate sensitive. There's no question about that. There's demand destruction going on out there. So what we have seen historically, and we do have experience going back to the 2008 to 2009 Great Recession, if you will, in the MCA space. Historically, what we kind of recommend to our investors and what we see is this kind of playbook. We tend to see, as I just mentioned, kind of a softening or a heightening of delinquency rates in the smaller merchants, lower FICOs, kind of lower credit quality type of merchant deals. What we like to kind of drive or kind of ask investors to consider is moving up in the quality, as I mentioned before, moving up in the FICO brackets, trying to participate in kind of larger deal sizes with higher quality merchants. When we're kind of heading into recession, in the midst of a recession, that's a great way to kind of position your portfolio in the merchant cash advance industry. You're really trying to protect capital, earn a nice return at the same time. But the risk probably isn't worth it if you're down in those sub 600 or even, arguably sub 650 FICO buckets. Now that said, what we like to do also, as we, depending on one's view of where we are in that recession, is we begin to kind of move out of a recession. Let's say if we do see the light at the end of the tunnel, we do get a more accommodative Fed at some point in 2023, and we begin to see the economy perhaps accelerate. It may not happen until 2024. That's when I think it makes a lot of sense for an investor to think about taking a bit more risk and then maybe dropping those FICO buckets down in their self-directed model back down into the sub 650s, sub 600s, and take advantage of the very high factor rates and pricing that's down in that level, which makes a lot of sense. The other thing that I would highlight, which is maybe counterintuitive, but really makes a lot of sense. I mentioned the kind of tightening cycle that's going on in the credit markets right now, and that feeds itself right through the economy, right to these businesses. Like I said, first it hits the very interest rate sensitive type of industries, but it feeds itself down into manufacturing, shipping, trucking, et cetera, all the way down through the food chain. Traditionally, what we've seen also there, as I think many of investors on this call can imagine, is as credit conditions tighten, that means the banks are pulling back. That means other alternative lenders who traditionally get their funding capabilities from those banks who are tightening, they all pull back and restrict credit to the businesses they were formerly providing credit for. So what we tend to see kind of in the belly of a recession, and we're seeing that right now anecdotally, actually we're seeing it in the data, to be honest, we're beginning to see higher quality merchants begin to fall into the MCA space who would never previously been applicants for a merchant cash advance. They would typically get their working capital needs satisfied from a bank, from, as I mentioned, an alternative lender at a relatively attractive rate. But because credit is contracting from those banks, from those alt lenders, we're seeing much higher credit quality, much larger businesses falling into the MCA space. And importantly, the pricing in the MCA space stays relatively strong, stays relatively kind of stagnant. We don't see a lot of pricing pressure. So you're getting a much higher quality of a merchant at a price point that was similar to what we saw in much easier credit conditions back in 2020 and in early 2021, if that makes sense.
Yeah, that makes perfect sense. So heading into the new year, we can anticipate those better quality merchants flowing into the MCA space. But in the interim, certainly investors should err on the side of safety, or I guess more conservative for the time being, and basically participate into those better quality deals. And the good news is that we have plenty of deal flow where investors can rest assured that they can go in. And even though they're blocking out some of those poor quality deals, it does not mean that there will not be enough deal flow there. There's more than enough.
Yeah, that's a good point, Jen. And it really depends on each investor, right? But in there, the way they've structured their portfolio, I mean, the key, I think we always tell investors, is diversification is key. You never want to be too exposed into any one deal. My rule of thumb, it's just a rule of thumb, but I always like to think of never more than 1% of a position in any of your total portfolio in any one singular deal, to make sure you're well diversified across board. But as you do, one nuance to that is, as you do move up that quality spectrum, investors may want to think about, they can take kind of may think about taking a larger participation in those higher credit quality deals relative to their portfolio than they would in kind of the higher risk sub 650, call it FICO scores. If you're moving up, north of 700 in your FICO scores participations, that may do well to take a little larger exposure on a per deal basis. Don't go crazy, but you may want to increase that exposure as you move up, because the quality's better. The term's going to be a little longer, so the velocity will be a little slower, but I think it's prudent in this environment.
Fantastic. And I just want to point out here briefly that there was a poll that just went up on everyone's screen there. Make sure to answer that poll so we can see what the #1 requested offering or product would be for the new year. We're very curious to hear from everyone. So JD, a lot of good points. I think a lot of our investors would also love to hear a little bit more about what Supervest has in store in 2023, products, initiatives, offerings, anything you can share with us on that front?
Yeah, absolutely. I guess again, I'll do a quick look back to 2022 first, Jen, but the first big thing is what we just kind of went through in November, kind of our integration, migration, our introduction of our Supervest 2.0 new UI. That was very big for us. Nervous times as we went through the migration, but I think we made it through unscathed, and I was pretty happy on how that integration works. Certainly, there are a few bugs here and there, and we appreciate all the investors who lived through some of those bugs. Thank you for your patience across the board, and we continue to smooth out any issues that are going on there. So moving forward into 2023, specific to that UI integration, you're going to continue to see improvements, features, functionality across the board. So think about 2.0 becoming 2.1, 2.2, 2.3, continued version improvements as we work our way through 2023. We'll probably see that on a quarterly basis, the version rollouts. Right now, we're working through multi-week sprints with kind of fixes and small feature improvements that all of you have suggested. We take all your suggestions to heart. Sometimes we can't get to all of them, but believe me, we're investigating all of them. If they're doable, we're trying to implement them as quick as we can. So that's probably one of the biggest things, Jen, looking out to 2023. I think on the product side, we definitely have in the works a couple of new products. Specifically, we're going to introduce a couple new flavors, if you will, of our note product, which saw some great success and traction in 2022. So look for that probably the end of Q1 or early Q2. Probably be a very similar version to our current 12% note product that pays a quarterly dividend of 3%. A lot of money's locked up for 2 years. I think what we'd like to offer right now is, and maybe a new offering, is some type of shorter term note, maybe somewhere around a year, perhaps with monthly payments. That's TBD. We're working with our counsel right now to kind of get that papered and finalized, but look for that to be introduced probably, like I said, end of Q1, hopefully at the latest by early Q2. And then I think what we're always doing here from a risk and underwriting perspective is introducing new funders onto the platform once they've gone through our diligence program and underwriting process. So we did onboard 2 new funders in 2022. I know Roland, who is heads our risk and underwriting team, is working on a couple of new funders right now on the diligence side. So look for that. Potentially some additional funders coming onto the platform. Again, more flow, more hopefully quality flow coming from those funders.
Fantastic. And for everyone that does have any questions regarding what JD just mentioned in terms of our new offerings, or any feedback, suggestions, thoughts, requests in terms of the new improvements and functionalities we're working on with the UI and the new UI release, or the version 2.1, as you called it, JD, please email us. You can always reach us at support@supervest.com, and we will log all of those requests, answer any questions you have in a timely manner. Once again, support@supervest.com. So JD, I think we touched upon most of the major points. I want to turn it over to the investors on the call. We want to hear from you and answer any questions that you have live on the webinar now. So
Sure.
If anyone has questions that need answering, do not be shy. Let's take a look here and see who we have. All right, JD, here's one. Mm-hmm. So I am a potential investor, very interested. However, I'm concerned about the stability of the company, the risk of the funds, and your ability to manage it. Can you comment on this?
Sure, I think that's a great question. I think that's the perfect question that I alluded to. What occurred in the crypto markets and some of these crypto platforms over the last year. It's really about doing your due diligence. In terms of our stability, we've been around since 2018. We recently incorporated last year, and specifically in terms of stability, while we're a young company, currently still, we just closed on a $5 million fundraising round, which certainly gives us plenty of runway over the next few years. We are currently cash flow positive in our existing business. We've always run our business very close to cash flow positive, kind of bumping back and forth depending on new hires and new initiatives that maybe we bring in there. So we're very prudent managers in terms of running our business here. And again, our recent fundraising round really gives us kind of a backstop in terms of sticking around for the long term.
Excellent. And another pertinent question here, JD. Do you have plans to lower the minimum investment amount so that more investors can participate and test the waters, quote unquote, with Supervest before putting in more funds? So I think this speaks to why we've increased that minimum. It'd be a good thing to sort of review.
Yeah, it's a great question. The reason we kind of made that decision to increase what we'll call the self-directed model versus the note, we actually lowered the minimum in the note to make that more accessible to investors. And again, you have to be an accredited investor to invest in any of the offerings at Supervest. But really what we found is the smaller amounts, by investing only, say, $25,000 in the self-directed model, excuse me, we found it very difficult for people to really diversify their portfolios in a meaningful manner across the deal flow that we saw. And then there's a bit of a challenge that small of a deal flow kind of size into our funding relationships too. So we did make the business decision that made sense for Supervest, and it also makes sense for an investor's portfolio to raise that minimum from 25,000 to right now at 75,000. And I'll be honest with everyone, it's probably going to go higher over time. We're seeing a lot of interest from folks both on the institutional side and kind of the H&Ws and the ultra high net worth folks that makes sense for us. And I think it makes sense for the investor that they really need kind of almost a minimum of $100,000 to make it work in the self-directed model to make that portfolio well diversified.
Excellent. And JD, how many funders do we currently work with, and were any let go in 2022?
Yeah, we've had one funder that we did let go in 2022. We also downsized one funder in terms of screening away a certain portion of their deal flow that we were not too happy about their performance in that particular subset of deal flow. So we screened that. And like I mentioned before, we did add two funders in 2022. In talking to Roland, I think we've probably got on the docket maybe another 2 or 3, at least in focus right now for 2023.
Excellent.
Oh, and if I didn't mention, I think we're up to a total of 24 funders on the platform. I would say this is a bit of a ballpark, but I would say probably about 15 of those funders do 80% of the volume, to give some context to the participation of those funders.
Got it. Now, another question, would increasing the minimum monthly revenue for deals be wise at this point?
Yes. And that speaks to, my mention about moving up the credit ladder or moving up credit quality. Larger monthly revenues for the underlying merchant, it's a linear set to it's a larger business, tend to be more stable. So that's what I like right now. If you have the ability to move up into a higher monthly revenue merchant subset, I think that makes all the sense in the world, given the kind of economic landscape or environment we're in right now. I think it's better to be cautious. Now, those type of deal flows, for the most part, all things being equal on average, they're probably going to be a little lower factor rate than we've seen over the years on the platform. they may be 1.30s to 1.40s, and they may be longer terms. They may stretch rather than the average term that we've seen on the platform around 6 months. Those may be more likely 8 to 10 month deals. But I think that's being more conservative and being a little more cognizant of the risk, and there'll be definitely more stable, less volatility in that return stream from those type of merchants. So I think that makes all the sense in the world.
Absolutely. Now, JD, can you please comment on what our current default rate on MCAs look like? Have there been increases since the recessionary period began? And how do we compare to the MCA space at large?
Yeah, I always hate to say this, but I always say this to everyone, Jim, when we talk to investors individually, but it depends, right? It depends on what kind of portfolio, you as the investor kind of designs. I'll put it this way: the portfolio that we run internally that underlines kind of our node products, that default rate is probably running around 10-11%. That portfolio is run relatively conservatively. Like I said, it's the way we run that portfolio is probably, as I mentioned here, we've been moving up the FICO bands. We've been going for higher monthly receivables from the underlying merchant. We're willing to stretch out term because we think those are somewhat safer deals and higher quality. So that's where we're in right now. Now, if people are, looking at higher factors, or, like our Roland likes to say, are factor hunting and chasing, 150s or 155 factors, they're going to see a much higher default rate there. That can be in the mid-teens, sometimes into the high teens, depending on what industry subsects they could get exposed to. So, and then we see very, very conservative portfolios that are in the high single digits on the platform, who are extremely conservative. So it's always tough to say. It really depends on the complexion or the composition of the criteria set an individual points up. But that kind of gives you a broad base of what those DQs look like. I think the industry, to your point on the industry, it's similar. What I'll call that high risk paper, I'll call that C paper, D paper. The default rates have certainly risen through 2022. Those are probably high teens. In some cases, poor underwriting gets you into the mid 20s. I think the AB paper is still in the high single digits for the A paper, and you're probably in the low double digits, 10 to 12 for the B paper that's out there. I think the industry's seeing that right there. But again, it depends on the funders. There are funders who are excellent underwriters, have good processes in place, and work at it. They're doing well, and they're managing that risk accordingly. There are some funders in the time of easy money who really were just throwing money at the space. They're seeing their defaults rise at a rapid rate. And look, that's our job, is to understand who those funders are, not let them on the platform, underwrite good funders, and allow them to partner with us and allow us to source deal flow from them to our end investors.
Right. And that sort of leads us to another question here, JDS, how we manage that risk during a potential recession. And a lot of that comes down to the due diligence we conduct with our funding partners, their underwriting, their MCA infrastructure, right? And the ongoing due diligence we conduct on an ongoing basis through weekly, quarterly, monthly portfolio reviews for each individual funder. Is there anything you'd like to add on that front? Other ways in which we manage the risk in terms of deal flow and our funders, our funding partners?
No, that's a big part of it, Jen. That's the initial due diligence when we first look at a funder to onboard, and then, as you mentioned, we have ongoing due diligence quarterly, semi-annually on sites with those funders. But really, the biggest diligence occurs every day. We're looking at these portfolios and deal flows and deal performance of our funders every single day and seeing how they're performing. And as I mentioned before, I think, we talked about an earlier question of have we kicked any funders off? I alluded to one funder that we screened out some of their deal flow because we didn't like a certain subsect of it. So one of the things we do here, kind of a netting over our kind of deal flow, is if we do see, a funders that are performing, we will kick them off. If we do see, a funders that are performing, we will keep them on. So if we do see kind of a funder with a certain subsection, as I mentioned, of deal flow that seems to be underperforming or it just doesn't make sense to us, we'll block that type of deal flow. We'll have a conversation with the funder, we'll explain to them what we're doing, but and why we're doing it. But we will put that netting over, before that deal flow can even get to our investors. That's somewhat reactive. We have to see the underperformance first before we can react to it, but we will do that, and we have done that.
Fantastic. Now, one of the questions I've gotten over and over again is, in regards to the FICO bands, those poorer quality merchants that are below 650 or below 600. Obviously, there are several funders out there across the US that specialize in different types of paper, where I call it A paper, B paper, C paper, all the way down to F paper. And by paper, we mean the quality of that merchant, A being
Sure.
Better quality, right? F being lower quality. So
Correct.
Why does Supervest allow deals on the platform that are sub 600 or sub 500 FICO score if perhaps ROI isn't substantially better in those better quality merchants that are defaulting a lot less?
Because at times they are, and I don't mean to be be cute with that, but as there are times when those C and even D paper can be extremely attractive. Like I said, as we if we do see the light at the end of the tunnel and the economy begins to accelerate again, C and D paper can be extremely attractive at those times. And over time, the C and D paper does pay, but there's an inherent amount of volatility in that paper. Particularly as you move into recession, it's probably going to be bad volatility, down volatility. But if you get into a situation where where the economy is coming back strong, that CD paper can be extremely attractive because those things are getting priced at 150s, even as high as 160s, and even higher. If those default rates can fall as low as low double digits, 12-15%, that's extremely attractive return potential for an end investor participating in that deal flow. But there's a lot of volatility in that deal flow. So we do offer that, and we'll continue to offer that. But I think we like to manage it, and our kind of recommendation for investors, part of this call is to, in this environment, probably the right thing to do is to maybe move up that credit quality as we existed. But there are certainly opportune times to look down into that C paper where the factors are quite high. The terms are very short, 3 to 5 month deals. So the velocity of that capital turn can be quite high, and you can support, if it's a favorable environment for that type of deal flow, it's a 15% DQs or delinquencies in that type of deal flow is extremely attractive on a final or end return type of perspective.
Fantastic. So the timing of it is really important. Wonderful. And JD, speaking of just performance, the recession, another commonly asked question is, outside of trucking, of course, are there other industries that investors should have their eye on that are more volatile or are just showing variable performance, if you will?
Yeah. I think, one of the things I always say to investors, and I think all our investors, well, obviously they're all accredited, and I think they're an incredibly sophisticated group of people, all very bright, at least all the ones I've talked to. It's kind of, you got to think about it, look at the world, look at the economy, look at the industries, just the way, you would think about what's attractive or what's not attractive out there. So, for example, like right now, we all know rates are backing up. We all know, well, that means interest rate sensitive industries are taking a hit. The first thing that's kind of taken a hit kind of recently, we've seen housing has slowed down after having an incredible run over the last 3 to 5 years because of the low interest rate environment. Housing starts are down, new housing starts are down, the mortgage applications are down, refis are down. So that immediately tells to me that, okay, maybe I should lighten my exposure in the general contracting space because they're the guys who build houses. So maybe I want to move up the FICO bands in the construction space, general construction space, and get away from kind of the riskier contractors that are out there building houses. You know, common sense kind of approaches to your industry selection makes sense there. And conversely, you know, specialty construction industry, I still think that makes a lot of sense, because that's your electricians, that's your plumbers. Those are the folks that, no matter if you're in a recession or in the boom times, if your pipes break, you got to get the plumber over, because you're going to need that plumber. Same with your electricity goes out, you need that, you blow your fuse box, you need your electrician. Those tend to be, you know, somewhat recession resistant type of industries. So I'd like to still play in those kind of those bands. So, you know, industries that just make sense, like, hey, we're going to recession, what could get hurt? Housing's hurt. Maybe I suggest moving up the FICO bucket in those kind of industries. You know, contractors, like I said, the trucking, all of a sudden we start to see a Walmart or Amazon start to miss their earnings. Well, that means there's less product being shipped. So maybe you want to dial up your FICO exposure to truckers. You know, it all makes sense. So I always think, you know, most people have a very good idea what the world is going on. The merchants that we're funding, for the most part, are Main Street merchants. So it's really look around, you know, what do you see being impacted? And that's the best way to dial your exposure.
Fantastic. So I'm hearing, look at the news, you know, keep your eyes and ears open and keep track of what's happening in real time. And then, of course, look at the performance of your own portfolio as well, trends, you know, what's happening across industries, FICO score, term, etc. And then course correct as you go.
Absolutely.
Wonderful. Well, JD, we're just a little over our time here, but super insightful. Thank you so much for all of that information. And thank you to everyone that joined us on the call today. As always, we greatly, greatly appreciate your support, and we look forward to continuing to serve you in 2023. If you have any questions at all beyond today, please feel free to contact us. Again, that email will be support@supervest.com. And thank you again. We'll see you next time. Thanks, JD.
Jen. That was great being with you. Thanks, everybody. Bye.